18 minutes to talk about everything going on in enterprise
17:45. It's moving away from us.
So we're going to skip the introductions.
Cool.
I'm Ari. These are the VCs.
Interchangeable commodities, VCs. Good.
There you go. So evidently, Salesforce.com is for sale. So the reports say. I'm going to ask you each something slightly different about it, so we don't get too mired in this. But what do you make of these reports? Does it make sense for Salesforce to be part of a bigger? Does it make sense for a massive company to be part of an even bigger company?
No, I'll take it. I think it's the rumor's been around for a long time. The rumor for a while has been that Oracle would buy Salesforce, and Mark was going to be the next heir apparent to Larry and take over Oracle. There's been the rumor that Microsoft would buy because they want to have a deeper business in the cloud. And I actually think with Satya coming in, it's an interesting rumor because he is very focused on the cloud. I love Salesforce. I own the stock personally. I think it's a tremendous company. I've owned it for, 14 years. So I'd hate to see it become part of something bigger because I think it's such a tremendous company that does so much for the community. But it would make sense. I could see it making sense for either of those companies.
Karan, let me ask you. Salesforce has been a tremendous acquirer of startups, of enterprise software startups. Do you worry about that going away, and so there being one less acquirer in the ecosystem?
I do. I mean, I think at the end of the day, all of us have a lot of respect for Salesforce as a company, as an acquirer. But I do think if this were to happen, it's a huge validation for software as a service in general, and the fact that Microsoft would make an acquisition of that size, I think it validates the SaaS wave that started 10 years ago with Salesforce and continues to accelerate. So in some ways, yes, I would be unhappy that Salesforce would be removed as an acquirer, but in a lot of ways, as a SaaS investor, I think it's a huge validation for the space that we've been investing tons of dollars in.
And Rory, would it be a bigger disaster than if Microsoft had bought Yahoo?
Well, if Microsoft had bought, wouldn't it be a bigger disaster for the Yahoo shareholders? Whenever someone does a dumb acquisition, remember that definitionally, that means someone is a crazy winner, right? So you got to be precise. Bigger disaster for whom? Don't know. I think there's no doubt that Microsoft buying Salesforce would be less value destructive than Microsoft buying Yahoo, but that's a tremendously low bar with which to evaluate investments, right? Microsoft does not need another business with, flat EBITDA, flat revenue growth. They got enough of those of their own. Salesforce would be a far better buy. I mean, personally, the biggest point to me is it's 15 years too late. In 1999 and 2002, 2003, Salesforce bought Great Plains Software and Navision for about $1 billion each, total $2.2 billion. The next year, they could have bought Salesforce for $2 billion, which was obviously the correct move. They bought the last two client-server software companies instead of the first SaaS company. How do you feel about them rectifying that mistake for $55 billion plus a premium 15 years later? Ecstatic, because I'm a Salesforce stockholder too. For Microsoft, it's buying relevance at the expense of shareholder value. Who am I to say that they shouldn't do that? But I wouldn't be ecstatic if I was a stockholder.
Got it. So here's how we're going to address the bubble question. The Wall Street Journal has their unicorn list. Of the 87 companies on their billion-dollar unicorn club, 27 are software companies. The biggest is Palantir, $15 billion. The Bessemer Cloud Index, so the Bessemer Cloud Index of publicly traded SaaS companies has 32 companies that are $1 billion or more. So there are 32 publicly traded SaaS companies at $1 billion or more, 27 privately held. What does that mean? I'll start with you, Rory.
It means that it's a damn sight harder to maintain a valuation of north of $1 billion when you have to maintain it every day and every trader can buy and sell you every minute of that day, versus as a privately held company when you can only have to trade once, you only have to trade to one person, and you can trade with terms which none of us are aware of that allow that $1 billion valuation to be almost anything you want it to be. There's an old joke when you're raising money from a hedge fund that they say to you, you tell us the price and we'll tell you the terms. And those fine, clever boys, they can write a deal that gives you your notional headline value and gives them what they need. So I don't really know how to, it's much harder to assess the value of a privately held company. Some of them will go from $1 billion to $5 billion and it'll be yay them. And some of them will go from $1 billion to $500 million and it'll be really sad, right? And the allocation of that value destruction between the new investors and the existings is all dependent on terms, again, about which none of us know anything. So some of them are probably way overvalued. Oh well, buyer beware.
I think there's something else happening right now which hasn't happened before. If you look at all the late stage private rounds that were done last year, 40% of the money that went into it was actually from public investors coming into the space. And you know, I can't reveal sources, but when you talk to some of these public investors and you ask them, like, well, how can they justify some of these billion-dollar valuations that they're paying? I think there's another level to the answer, which is not just that they think that that's what it's worth. I think what they realize is that they're getting a level of information about these companies at that stage that they would never get once these companies are public. And there's a premium they'll pay for that. And I think that's one of the things that's driving some of these valuations up too. Who knows if it continues or not, but I think the flip side to that is when these late stage private valuations go up because public investors are coming in, you could potentially, I'm not saying the bankers are doing it, but you could potentially think of bankers going up to the public investors saying, you can get this at a discount because we know the guys marked it up in the last private round. So there's a lot of layers to this that I think are hard to weed through, but it's for sure that there's a lot of public money doing late stage private rounds right now.
Jeff, let me ask you this way. Say you're an investor in a enterprise software company at a earlier round, before valuations got crazy. These term sheets are now being thrown around for your companies from bigger investors at $1 billion plus. How do you advise the companies on whether it's right and when it's right to take that kind of money?
Well, so we have one that just raised, Domo, Josh James' company, just raised $200 million. They were very public with the valuation. And, we participated in the Series B relatively early in the company. We then just doubled down in the current round. We think that there's value even at that price. And I think what you see Josh doing, this is a proven entrepreneur who sold his last company for $1.8 billion. He knows what the mechanics of growing a company into scale look like. He knows the challenges that he faced in the past, and one of them was access to capital at the right times. And so he's taking advantage of that capital when it's given to him on favorable terms. And he's got a growth rate that is, faster than pretty much any SaaS company we've ever seen, faster than Workday. So there's an argument to be made, even on behalf of the public investor, that this is a fairly interesting company to own a large position in, that you wouldn't be able to buy in an IPO. Company goes public, raises $200 million, you get a 10% allocation, you own a $20 million position. The BlackRock fund that invested in Domo is a $100 billion fund. That's just not meaningful. So taking these larger positions in some cases is a function of their fund and what they're trying to do in a company that they want to own for the next 5 to 10 years. And I think it's a smart move on the part of the entrepreneur if they know what they're going to do with that capital. And in that case, we have an entrepreneur who we believe does.
The cash burn question is now, I feel like it sort of replaced the bubble question. Are companies burning too much cash? I guess it's sort of a yes or no question. Maybe I'll phrase it as, what sort of behaviors are you seeing that may concern you, if any, about sort of the spending that's happening right now? Rory?
I mean, you're never as efficient when you're growing quickly as you are when you're growing more slowly. The reality is, I often say to my companies, we're not playing the efficiency game, we're playing predominantly the effectiveness game, and the amount of efficiency you inject into the system over time is a function of, as growth slows, you try and get more efficient. As capital gets scarce, you try and get more efficient. As competition fades, you try and get more efficient to maximize your profits. But you're in a toe-to-toe fight with a bunch of other companies, and the winner gets most of the value. You don't sit there and say, let's be efficient. You say, let's be effective. I mean, I know Josh well. I was on Josh's first board. That man was one of the most effective entrepreneurs I've ever seen. I'm not sure efficiency was his number one objective. I'm also on the board of Box. And people, give Box a lot of grief about, oh my gosh, all the money you burnt. Let me recite some names to you. Hightail, SugarSync, Huddle. These are all interesting companies who just never got to critical mass. And you had to do what it had to take in this marketplace to get to critical mass, and sometimes that means you spend a little money, right? Now, can you overdo it? Yeah. I mean, and are there going to be people who veer? Look, as you go fast, the line between being very aggressive but still sensible and being just crazy and pissing away money is a pretty tight line, and you got to watch it all the time. So as a board, you push on that burn, right? But it's not the absolute dollar that makes something dumb or not dumb. It's a much more nuanced question than that. And in general, so far, I haven't had the moment of, oh, I regret that last X million dollars. It's been great. The winner is taking such a huge amount of the value, and the winning is happening so quickly that you know, unfortunately right now, the option of slow, steady growth, which sounds so mature and sensible, it's a license to die because you're going to accumulate tech debt, and 5 years from now, you won't be able to afford to redo your stack. So you're just a company that doesn't really matter all that much.
Yeah, there was the great Aaron Levy quote in the Journal a couple weeks ago. We'll save ourselves right to irrelevant.
Totally. Exactly. Quote I always used to say here, no one ever said at the end of World War II, did you get this thing done on budget? When you want to win, you don't ask about the budget. You get it done.
Yeah.
Just, by the way, the two together, don't run out of money.
I think the thing is, the other thing the average reader of these lists doesn't quite comprehend is the investors in these companies fully understand that not all of them will be worth more tomorrow than they're valuing them at today. That's part of the business that we're in, right? You're making a forward bet on the value of a company 3 to 5 years down the road. Sometimes you're right and sometimes you're wrong. It's actually quite stressful because you have to get comfortable with that as you get into the business. But the average consumer thinks, oh my God, they're thinking 87 companies are all going to be worth 3 times more than they're valued today. The average VC is saying, I'll be thrilled if half of those companies in 5 years are worth more than they're worth today. So there's a little bit of a perception issue, I think, when we look at those lists.
One of the iron rules of venture, you only lose your money once. You can make 5, 10, 20 times the money. That's important.
I think the only difference I would agree with both what Jeff and Rory have said. I think the only difference that I see in the market right now relative to when Josh started Omniture is that the Me Too ecosystem has been overfunded quite a bit more than it ever has been. So for every Domo, there's 15 other BI companies that are probably burning money at the same rate, but will potentially never see that outcome. And that's the part that worries me as an investor, right? It's not the fact that Domo's burning whatever it's burning or Box was burning, because these companies are potentially creating categories. And I think for that, it's all about grabbing, mind share, and it's a land grab. But my worry is that for every true iconic category creating company, there's 15 behind it that has been overfunded because of the capital that's been infused into the ecosystem.
I think they have been, but at the risk of, I'm not blasé about the market and the valuations right now, but the smart thing about the crossover guys is they will give $200 million to the winner, and they won't give the time of day to third place. We all have companies that are number one, and we all have companies that are number three. The number three company can raise a $10 or $15 million round on turf terms. What they're not saying is $200 million plus going to the winner. So I think that moderates it to some extent. We'll own that problem, not BlackRock.
So let's talk about one specific theme within software, open source. The amount of money that's pouring into Hadoop, to NoSQL, Docker is a Trinity company. You have MuleSoft out there. You have companies that are trying to commercialize open source, which historically has been a very, very challenging way to live. Lots of companies out there raising lots of money. What fundamentally has changed about the ability to win with an open source like business versus 5, 10, 15 years ago when we've really only seen Red Hat, as far as I know, that's succeeded in this?
I can speak to Docker in particular, but I would say 80% of it probably hasn't changed in that it's still very tough to monetize an open source platform. And there's really opportune times for you to get the maximum value when you're at the local maximum of hype, which is sort of where I would say Docker is today. Or if you go down for a few years and come back and build a huge revenue run rate business. I think the interesting thing about Docker is it's riding a huge secular trend around the power shifting from IT to DevOps. And for us, we think that this company has the potential to be much bigger than VMware, right? And that's what sort of keeps us going and keeps us positive about the outcome of Docker and specifically. But I would say in general, it's still very hard to build a huge revenue business with an open source platform.
Either of you have views on investing in open source? We have, and I agree with everything Karan said. It's, if you're a unique product like that, a Me Too product, tough. A replacement product in an existing market, tough. I think Cloudera did well because it wasn't just open source model, but it was a unique and new thing that you could monetize. Ditto Docker. We're in Chef, which is very DevOps focused. But all the time, you talk to any sales guy in a open source company, and their biggest competition is their own product, and your average enterprise sales guy hates that. So it's about a lot of product positioning to make sure you have enough value in the upsell product to make the math work.
I do think there's two trends that are on the bull side of the enterprise valuations here. One is the shift from IT to DevOps, and that is a massive, massive, massive shift. The other one is mobile. 5 years ago, an enterprise user had a BlackBerry, some crappy Lenovo laptop, and there was no intersection between their applications and their mobile device. I was at a conference recently for one of our portfolio companies, and every customer in the room showed me the mobile version of the application and how they were using it. That never would have happened 5 years ago. So you've got adoption in the enterprise of mobile that's sort of quietly happening without a lot of coverage, although recently Apple just announced that enterprise is going to be a major focus for them. So this whole concept of mobile and what mobile is going to do in the enterprise, I think we're in the first inning of that, and that is some of the bull case that you would hear from venture investors as to why we're seeing these companies with just enormous market opportunities that maybe we didn't see a year or two ago.
Yeah, so I'm glad you mentioned Apple, because one of the things that I like to think about in terms of where enterprise spend is headed is how much of the incremental spend or the shift in spend goes towards Apple, Amazon, and Google versus a whole new set of companies that you're investing in. And so when you think about who are the competitors for those dollars, how much are you thinking about those companies?
All those guys are really, really, really strong competitors. No, I mean, I think that those three, and it's got to be said, a resurgent Microsoft are relevant in every deal you're talking about in a way that even 5 years ago it wasn't. I mean, Apple gets all the hardware dollars. It doesn't do a great job in enterprise, but the products are good enough that people make that happen. Amazon is astonishingly dominant. The single most important story of this year, in my view, in IT, is Amazon unveiled the numbers. Yeah. It's more revenue than Salesforce. It's growing, actually a little bit less. It's growing at 45%, not sub 30%, and it's printing money. Amazon has won, and if I was the CEO of HP or IBM and I read those numbers, I would literally throw up in the waste bin. Yeah. It's like, what do you do? Yeah. I'm competing against someone for a computing platform that's doing $5 billion and adding $2 billion a year. And I've been flat for 10 years at 2% growth rate. Amazon's great. And Google, again, same thing. They do a magnificent job of yanking Microsoft's chain, spending very little money and giving it all away for free and eroding the office space. These are tough people to compete with. And now you got Facebook at work. I'm not sure what it means, but wow. It's tough. There's real big players out there, and they're good.
Yeah. Nothing to add.
Yeah. So really quickly, if you take the legacy IT companies that are either not growing or losing market share today, which one is most at risk, and so existential risk, which one is most likely to either not be around in 5 years or to be completely irrelevant? Jeff?
Well, I think a lot of them are already becoming irrelevant, as Rory just mentioned. I would say the one that's interesting to me, and it not had a lot of coverage in the last year, is Dell.
Dell.
I think with Michael Dell coming back, you're starting to see a little bit of mojo, a little attitude in their advertising campaign. They look like they might take some risks, whereas companies like HP, IBM, even NetApp and EMC, they're just not part of the conversation anymore. I would echo the comment on Microsoft. I think is making a resurgence, and I think Dell. I'm intrigued to see what Michael Dell's going to do with Dell. So that's
because Dell's a venture-backed company now.
That's a very big venture bet.
Very big venture bet.
Karan, who's most at risk?
It's hard to pinpoint, but I'd say companies like SAP. I'm looking at companies like SAP and Dell and trying to see what they're going to do to stay relevant. And what I see happening right now are diving catch attempts and Hail Marys to try and stay relevant in a market that is moving faster than they can adapt to. And so, I don't know, but those are the companies that I would watch.
I think the actual quote is MacArthur. Old soldiers never die, they just fade away. All these companies don't die. They just become NCR. They become bull computing. They become Teradata. Just crappy, irrelevant companies that serve a certain customer set and can milk those customers for another 20 years and have a flat stock price and just not matter. They don't go poof in the night, right? They just, DEC was around until Compaq bought them, right? Tandem was around until Compaq bought them. They just will be increasingly irrelevant, and the CEOs will be managing incredibly boring shrinking problems. It's, just quiet obsolescence.
Quiet
Some of these
obsolescence.
companies like Tableau, I mean, they were 10 years ahead of their time, and unfortunately, that was 10 years ago,
Yeah.
and nothing has happened since then. So those are all companies that are up for taking.
Yeah. Great. Jeff, Karan, Rory, thank you very much. Enjoy the rest of the show. And,
Yay!
Thanks,
Thank
Harry.
you.